Hey, what's going on, Cashflow Hackers? It's Chris with Life 180, and this video, I'm gonna be talking to all of my 50-year-olds who are looking to retire and looking to be able to get to retirement at the age of 65 comfortably. Now, this video is inspired by a lot of research I've been doing, a lot of just kind of digging around. I found some documentation on the Federal Reserve website that was talking about incomes, right? Talking about not just incomes, but the average savings that people have by age bracket. And one of the statistics, well, first of all, obviously I've looked this information up a lot and it's changed over the years. When the market goes well, the amount of savings goes up, and then when we have a downward cycle, so to speak, the amount of savings goes down. That's just because it's not really savings. It's one of my pet peeves is people call it retirement savings, but it's really not. It's really retirement investments. And investments have a tendency to lose money from time to time because they go through cycles like everything else. Now, I have a lot of videos on that topic. I'm not going to get into all the detail in this video, but the bottom line is this. I saw a statistic that blew my mind, and I'm going to look over here at my screen. So when I looked at this statistic, one of the things that blew my mind is that people ages 50 to 54 only had $146,000 saved, invested for retirement, right? Now, that's a pretty scary number because if you realize how that works, right? Like let's take a couple that earns $50,000 each, and so that's $100,000 for household income. And let's say they're saving 10% of their income each, right? Because this happens a lot because the way people go through the process of saving for retirement or investing for retirement, a lot of times when they were raising their family, when they were younger, they didn't save a lot. So what typically happens is people in their mid 40s to early 50s start to realize that the retirement game is real and they got to maybe play catch up to get to where they need to be. But by the time they start, they don't realize that they pretty much already have no chance of winning the catch-up game. And so all you can do at that point in time is do the best you can do. And really, most people don't realize that it's a futile effort and that they're never going to get there. And I want to show this. I want to illustrate this, that the average American family with $146,000 saved for the household, invested, I should say. I keep saying savings because that's how they have it written, but man, it drives me crazy. And so the amount of money invested for retirement is average of $146,000. So I'm going to use $150,000 as just a barometer, just because I like to keep numbers round when I'm doing this stuff. What I'm going to do is I'm going to share my screen here. All right, so you can see here I have a 50-year-old wants to retire at 65. Now, I'm just going to assume both of the people in the relationship, in the marriage, spouses are 50 each. I'm just assuming that. Or it can be an individual earning $100,000. It is what it is. It doesn't really matter. It's per household. And the life expectancy, let's just say we want to put a life expectancy to 90 because I think this day and age, if you're not planning till at least 90, it's a completely irresponsible way to plan. It's just life expectancy is getting better and better and better. So you can see current income of 100,000, annual savings of 10,000. They've saved a total of 150, right? So the average amount of invested capital for retirement at the age of 50 right now, between 50 and 54, I should say, is 146. So I'm just going to round it up for this guy or gal and make it 150. Now, they're assuming they're going to get an 8% return from here till they retire. When they retire, they're going to have a 4% distribution rate. They're going to earn 4% because it's what they're going to have to distribute at. Their inflation assumption is 3%. That's extremely conservative right now, considering we're in a very inflationary environment. That's going to go for at least the next year, is my guess. So we're going to have some low inflation years over the next 15 years to make up for the inflation that we have this year, right? I'm not going to deal with the tax bracket. I did put Social Security in for $24,000 a year with a 2% cost of living adjustment. I'm not ever going to make a plan for myself banking on Social Security, but 15 years is close enough. We can roll with that. And so what this is saying though is that because you're earning 100 and you're saving 10, that means your standard of living, your current lifestyle is based on $90,000 a year of income, right? So what does this do? that gets us here, age 50. By the end of age 50, you have 172,800 because you had the 150 to start, you saved the 10, you earn the 8% interest, and along the journey we go. So you can see by the time you hit retirement, you're at $824,000. Now here's the crazy part. Actually, you're at 824. You pull the 140 out for income your first year, and mind you, this, by the way, this 140 is the equivalent of the $90,000, I should say, based on today's money, right? So if your current lifestyle is 90, this 140 is taking this inflation number into account, right? So let's say because inflation right now is 7.5, let's say inflation is really more in the 4% range long term, right? And so what happens if that happens is it actually gets worse for you. The money doesn't go as far because you have to pull more money out for income. The cost of your required income is going to go up just to maintain your standard of living, right? It's going to grow faster. So that's important to understand. So when we look at that, you can see here for the average family, there's zero chance they're going to get where they want to go, right? Like I think expecting more than an 8% return is unrealistic. Let's say we can really stretch it and we want to make it a 10% rate of return, right? Okay. Well, now at 10% rate of return, instead of getting to $824,000, and this, by the way, this is assuming this is 10% compounded with no interrupting, no bad years at all, which is just like I'm painting just such a rosy picture here that it's just unrealistic. But you can see here the distributions are just not. It's just not gonna work, right? So if I wanna add in, why is it not adding in, end 100. There we go, save and return. I don't know why there we go. So, all right, so you can see here, I didn't have the defined benefit in there, right? So now you can see it, that you're pulling it out, your money is gaining. I'm gonna pop back in here the 10% because that just got jacked up on me. There we go. Now we're back in the game here. So when you look at it, a 64-year-old, if you got a 10% return, you're still only getting to $1 million. So if you've saved 150 to this point in time at 50, you're pretty much in this position where you have no shot, right? You're not going to get where you want to go, right? It's just not going to happen. And so the scary part is, what do you do? If you can't get there, you may have to save more, right? So the question is, if you want to make it so your money lasts until you're 90, how much more are you going to have to save? Well, the answer is you're going to have to save more than half of your income, right? You're going to have to save $66,000 a year, which quite frankly, once again, that is not an option for you to get to where you want to be, right? This is the value of compounding interest. And this is, when we talk about starting early and what to do when you're in your 20s and 30s, this is why, because if you wait and you think you're going to play catch up, unless you come into big sums of money and you increase your lifestyle, the only hope this person has is if they start, making so much more money over the next 10 years that they can save a much higher percentage of their income, right? And realistically speaking, that's not going to happen. And so one of the things that I've done is I wrote this book. It's called Cash Flow Hacking. I love this book. Because of the work that I've done with Mike Wolf over the last 8 years. And, my wife and I have been working with him for 8 years and doing a bunch of stuff with him. And here's what I can say is we've developed in this book, I call it what I call the retirement rescue plan, because of the fact that, we have a lot of people that are in this position that are at 50 at the average, they're on pace to be average, right? So if you're average in America, if you got 150, and you're 50 years old, it's easy to feel like, you're doing okay. But then you look at the numbers and that I've shown you here and you realize, okay, you're in a lot of trouble. Well, this is one of the reasons, I got to check that. This is one of the reasons we created a calculator to go along this book and talking about how can you get where you want to be. And here's the deal. I'm a big believer. Real estate is one of the only ways you can do. Now, it's not just any real estate. It's turnkey real estate, because if you're anything like me, you're not good with being a handyman. You don't want to unplug toilets. You don't want to deal with being a landlord, right? You don't want to deal with any of that. And so what I can tell you though, is that real estate will get you benefits that no other asset will get you. Plus it's going to protect you from inflation. It's going to help you create cash flow, and it's going to help you think about things completely differently than you've ever thought about them with your money. And the best part about it is, in the next decade, if you have $150,000 in an account, by the way, I don't care what age you are right now. If you have $150,000 in any account right now, I can show you how you can reach financial freedom in 10 years or less, and that's what this book is covering. So if you are interested in this book, I would say go down in the description below, click on the link, go get a copy, and we will go from there. So here we go. How much can you continually save every year for future properties to include in this? So what we're doing is, this is basically how much are you saving per year? How much are you investing per year in your current plan? So it's saying I'm 50, I have $150,000 saved. I'm willing to invest $10,000 a year or save $10,000 a year. I'm getting 8% of my money right now. If I were to get an investment property, what would the mortgage rate be? Let's say 4%. And if you're making $90,000 a year, that means per month, your freedom number, meaning this is what you need to maintain your standard of living. It's not about how much money I have, it's about how much cash flow I have. That's the number that matters. And as soon as we can get out of the mindset of thinking about accumulating a big pile of money, and we can start thinking about how to replace our cash flow, only then are you going to have the chance to get out, to get out of the problem that you've created for yourself by waiting this long, right? So I'm going to calculate the freedom number, and what it does is, you can see here, your annual freedom number is 90,000. If you buy rental properties, a rental property purchase at 250,000, so we're assuming that, annual property appreciation of 5%, mortgage rate of 4%, annual rent increase, because you're renting these out, they're cash flow properties, remember? Annual rent increase of 5%, which is normal. And by the way, all these numbers are part of a system that I do with my buddy Mike, right? Current investment average return, meaning what you're doing in your current setup, is 8%, right? So your cash flow hacking program summary is showing that years to reach your financial freedom number. And so here's the deal. 9 years and 6 months, what you're going to have is 14 rental properties with this strategy, creating a total cash flow monthly of $7,500. Now, in doing that, you're still going to be leveraged. Now, you can let that go. You can have those loans go off and just kind of manage themselves, because you don't have to pay them back. I always suggest that you pay them back the way that we do this, and I'll explain. We do this through a whole life insurance policy. It's the way to accelerate the growth, because I only deal with products that provide guarantees. That's what I do. Now, real estate, obviously, can't say that it's guaranteed, but what I can say is, from a long-term perspective, it's infinitely more safe, secure, beneficial than putting your money in a 401k or having money in mutual funds or anything of that nature. Now, what happens is, if you use this cash flow right here to pay back the policy loans that you have, or the line of credit attached to your policy loan, or attached to your policy that you have that you're leveraging your policy to be able to get the line of credit. If you do that, so for 2 years and 1 month, you're going to have all that money paid back. And at 11 years and 7 months from now, so by the time you're not even 62 in this example for a 50-year-old, you're going to have a net monthly rental revenue, so cash flow, of $9,737. You're going to have a total market value of your properties of $4.5 million. Now, granted, you have mortgages on that, right? But the bottom line, this is your net cash flow after your mortgage expenses. That's important to understand. So that is net. That is your free and clear cash flow. Now, total net rental property equity. So this is, if you were to liquidate your properties, you'd have $1.8 million. So you've gotten out of the system of this, of looking at being in this position, and you've put yourself in a position where you're going to have $9,000, let's just call it almost $10,000 a month, because $9,700 bucks, and in 12 years you have $9,700 and change, and $1.8 million of equity that you could liquidate your real estate portfolio and have that. Whereas over here, you get to this place and you're lucky if you even get to, $800,000 at any point in time. And it's just, this is one of the reasons that I love real estate. And I'm not kidding you. Like I call this retirement rescue plan because I know that this can be done. I've seen Mike do this with so many people. It's ridiculous. Like I said, if you want to do this and you want to do it the right way, real estate is the biggest bailout plan that I know for anybody in this position. I can tell you 90% of millionaires, in the research that I did to write this book, 90% of millionaires own real estate in some way, shape, or form, and they do it because of the cash flow and the tax benefits and the fact that they can leverage it. There's attributes of these assets that they need their money to accomplish for them, that they need their assets to accomplish for them, and only real estate will create those attributes. Actually, there are a couple other assets, but for the most part, most people can only take advantage of the real estate component of this. So here's the bottom line. If you want to do that, this is one of the reasons I talk about whole life insurance so much on this channel, is because of the fact that whole life is a force multiplier. It is an amplifier, an accelerator of helping create wealth faster. Because guess what? Going out and getting real estate on its own is all fine and good. Trust me, it's all fine and good. It'll get you where you want to go. It'll be successful. You'll be better than just putting your money into mutual funds and all that stuff. But if you want to accelerate the growth, if you want to have more control and guarantee that what you want to happen will happen when you want it to happen, whole life insurance added on, like bolted on to your real estate strategy for all you real estate investors out there, for everybody who's looking for that rescue plan for your retirement, is the only way to go. So if you have any questions, go ahead and comment in the comment section below. If you're interested in talking to anybody, go down below, click on the life180.com link. You can go through that process, set up a call with one of our endorsed agents, and no pressure. Literally, it's a completely no pressure consultation designed to just educate you, ask you questions, help give you clarity. That's one of the reasons we call it a clarity call. It's help give you clarity around what's going on in your life. Get clarity for us about where do you want to go, and help give you some guidance on maybe how do you bridge that gap to get where you want to go. So anyway, I hope you found value in this video. If you did, please smash that like button. Make sure you hit the subscribe button, click the bell. That way you get notified every time I launch a new video. And as always, until next video, have a blessed, inspirational day. We'll talk soon. See ya.